DFAI's 36% crushes VOE's 14%, a massive 22-point gap between two funds chasing the same value stocks. But here's where it gets interesting. DFAI crushed VOE by 24 points over 3 years. That's the difference between winning big and barely surviving. Now let's shift gears and look at VOE's 71% 5-year return. Proves value investing can deliver solid gains when you're patient enough to let it work. Here's where the story takes a turn. DFAI's 65% 5-year return looks solid, but it's actually trailing VOE over longer time frames, despite its recent wins. In plain English, DFAI is built for quick gains in the short term, while VOE plays the long game and wins over time. Your investment timeline decides which race car crosses your finish line first. Now for the real question, VOE's 14% gain over the past year is solid performance for a value fund, especially in a tough market environment. Let's dig into the details. DFAI's 36% 1-year return nearly tripled the benchmark. The international value strategy really crushed it here. Here's where things get revealing. DFAI's 66% 3-year return puts it among the top-performing value funds, elite territory that's tough to reach. Now let's put this in perspective. VOE's 42% 3-year return is solid, but it's clearly trailing behind DFAI's performance by a significant margin here. In plain English, it's like picking a race distance before the gun fires. DFAI sprints ahead short-term, VOE dominates the marathon. Your timeline literally decides which fund wins your money. Here's the thing though. DFAI's Sharpe ratio of 1.0 means you're getting solid returns without taking on excessive risk. That's the sweet spot for smart investors. Let's take a closer look. VOE's Sharpe ratio of 0.6 means you're taking on more risk without getting paid enough for it compared to DFAI. Now here's where it gets tricky. DFAI's Sortino ratio of 1.5 shows it's delivering solid returns while protecting you from the downside volatility that really hurts. In plain English, think of DFAI like planning a road trip. You're reaching your destination with fewer detours and pit stops. It's about efficiency, getting where you need to go without unnecessary zigzags. Let's see how this plays out. VOE's Sortino of 0.9 reveals higher downside risk per unit of return. You're taking more pain for what you're earning here. Here's what really matters. VOE took a rough hit with an 18% drawdown. That's the kind of drop that tests investor nerves and patience. Now let's connect the dots. DFAI's 13% max drawdown shows real downside protection. It softened the blow when markets got ugly over 3 years. In plain English, maximum drawdown is like falling downstairs. VOE tumbled 18 steps down, while DFAI only dropped 13. Both hurt your portfolio, but clearly one falls gentler on your wallet. Let's unpack this a bit. VOE took 136 days to recover from its worst drawdown. That's over 4 months of watching your portfolio crawl back. Here's the key takeaway. DFAI bounced back fast, just 20 days to recover fully. That's resilience you don't see in most funds during drawdowns. In plain English, when your investment crashes, how fast you bounce back matters just as much as the crash itself. VOE spent 2 laps in the pit, while DFAI recovered instantly. That's the difference. But there's a catch. You're turned to weigh in. Who takes this battle, VOE or DFAI? Let's get into the weeds here. VOE holds 185 stocks, selective enough to chase quality, diversified enough so one bad pick won't wreck your portfolio. DFAI spreads your money across nearly 4,000 companies worldwide. That's serious diversification hunting for global value opportunities. In plain English, VOE holds 185 stocks while DFAI spreads across 3,828. That's like having 20 times more egg baskets. If one company crashes, DFAI's investors barely feel it. That's diversification doing its job. Let's zoom in on this. VOE's 98% US exposure means you're betting pure domestic value here. Almost zero international interference to complicate the play. DFAI is making a bold call here, betting almost everything on international markets with barely any exposure to American stocks at all. In plain English, think of it like pizza slices at different restaurants. VOE serves up American pizza, while DFAI dishes out international flavors. They're not competing, they're just feeding different appetites in different markets. Let's break this down further. VOE dominates US value stocks, while DFAI spreads across international markets. They're not really competing, they're playing different games entirely. Now for the real question. VOE's 2.1% dividend yield provides steady cash flow. Perfect if you're looking for income while waiting for value stocks to shine. In plain English, VOE's dividend yield is like finding couch change regularly. 2.1% flowing into your pocket each year. It's steady income while you wait for bigger gains, keeping you paid along the way. Here's where things get revealing. DFAI's dividend yield sits at 2.4%. That's consistent income landing in your account while you wait for price appreciation. Now let's put this in perspective. DFAI's dividends grew 8% over 3 years. Your income stream's climbing steadily, not just sitting there collecting dust. But wait, there's more to this story. VOE's dividend grew just 5% over 3 years. Modest growth, but at least it's moving in the right direction for income investors. Here's the tale of the tape. DFAI dominated the 1 year with 36% returns and better safety. VOE took the 5-year crown at 71%, but they're playing completely different games here. In plain English, here's the race car analogy in action. DFAI's dividends accelerate at 8% annually, while VOE grows at just 5%. Both are winning, but DFAI is hitting the finish line way faster. Now here's where it gets tricky. At 0.07%, VOE's expense ratio is incredibly low. You're keeping almost every dollar of your returns here. But that's not the whole picture. DFAI's higher expense ratio means you're paying an extra 11 basis points compared to VOE, costs that quietly eat returns. Let's see how this plays out. VOE charges just 0.07%, while DFAI's 0.18% means you're losing an extra $110 annually on every $100,000 invested. In plain English, think of expense ratios as couch change slipping away each year. VOE loses just 7 cents per $100, while DFAI drops 18 cents. Tiny differences now, but they compound into serious money over decades. Now let's connect the dots. DFAI's 36% return easily justifies that 0.18% fee. Sometimes paying a bit more actually gets you something worthwhile. But hold on a second. VOE's betting big on financial services at 16%. That's a heavy tilt toward banks and insurance companies for this fund. Let's unpack this a bit. DFAI's betting big on banks and financial companies. A full quarter of its portfolio is now parked in this sector. In plain English, think of it like dividing up a pizza. DFAI grabs 24 slices of financial stocks, while VOE takes just 16. The bigger your slice, the wilder your ride when financials move. Now let's flip the script. VOE puts 13% into industrials. Think factories, railroads, and infrastructure. That's solid exposure to the economy's backbone and how things get built. But there's a catch. DFAI is putting 19% into industrials. That's a heavy bet on global manufacturing and infrastructure value plays right now. Let's get into the weeds here. VOE puts 10% into energy. That's a solid bet on oil, gas, and energy infrastructure in your portfolio. In plain English, think of sector allocations like slicing a pizza. DFAI loads up heavily on financials and industrials, while VOE spreads things out more evenly with a bigger energy slice. But here's where it gets interesting. DFAI is keeping energy exposure light at just 5%, a defensive move given how unpredictable this sector can be. Let's zoom in on this. DFAI doubled down on financials and industrials while VOE bet heavier on energy. Sector choices drive vastly different performance outcomes here. Here's where things get revealing. DFAI crushed VOE with 36% returns versus 14%, though VOE offered better downside protection and faster recovery from losses. In plain English, DFAI's recent performance is like a race car exploding off the line. Faster acceleration, smoother handling, fewer crashes. If you're judging by the last lap alone, it's the clear winner here. Let's break this down further. Over 5 years, domestic value crushed it with 71%, edging out international values 65%. Home team takes this round. Now for the real question, DFAI wins the risk game across every metric. Better ratios, gentler drops, quicker bounce backs, and smarter returns per dollar risked. Let's dig into the details. DFAI holds over 3,800 companies versus VOE's 185. That's 20 times more diversification, spreading your risk across global value stocks. In plain English, DFAI spreads your money across 3,828 companies, while VOE only holds 185. It's like couch change. More coins scattered means you're less screwed if you lose a few quarters under the cushions. Now let's put this in perspective. DFAI wins on both fronts, higher yield at 2.4% today, plus faster dividend growth at 8% compared to VOE's offerings. But wait, there's more to this story. VOE's 0.07% expense ratio beats DFAI's 0.18%. That gap compounds into serious savings over decades of investing. Here's the thing though. DFAI charges 11 basis points more, but delivers superior returns and better downside protection. You're paying for better outcomes, not just fees. In plain English, think of value for money like your report card for smart spending. Sure, you could pinch pennies everywhere, but constantly restocking gets expensive. Sometimes paying a bit more upfront saves you money long term. Now here's where it gets tricky. Geography explains everything here. VOE's 98% US exposure versus DFAI's 1.2% makes them complementary, not competing strategies. But that's not the whole picture. Here's where these funds really diverge. DFAI bets big on financials and industrials worldwide, while VOE loads up on energy domestically. Let's see how this plays out. DFAI wins this showdown with better returns, lower risk, faster recovery, more income, and superior diversification, worth the higher fee. Here's the marathon runner report card. DFAI sprints to A's in returns, risk, recovery, and income. Pure champion performance. VOE maintains steady B's, but wins on lower costs and longer endurance. So here's the verdict. DFAI's for risk takers chasing international growth, while VOE's your steady domestic value play for the long haul. In plain English, think of it like race cars. DFAI is the drag racer exploding off the line for maximum speed, while VOE is the endurance racer maintaining consistent pace for the long haul. Different races, different champions. Let's unpack this a bit. Legal stuff, not advice. Do your own research. Consult professionals before investing. Here's the key takeaway. If you want more head-to-head ETF battles like this, hit subscribe for weekly data-driven breakdowns. See you next week.